In this week's video, we'll review several data sets that tell us it's prudent to be prepared for a double-digit move in stocks before year-end. This is a Bloomberg article dated April 21st, 2020. The Fed is buying $41 billion of assets daily, and it's not alone. If you think $41 billion is a lot, it is. This is text from the same Bloomberg article. Keep it in mind, we'll be doubling back. Bloomberg, April 23rd, 2020. German Chancellor Angela Merkel vowed to back a huge stimulus package. All of that is relevant to the four major market scenarios that we've been covering for quite some time, and the data-based analysis that follows highlights the importance of learning to think in probabilities. Left side of the screen is a tweet dated April 22nd from Macro Charts, Twitter handle here where my cursor is. Just 76 days into 2020, stocks have already moved 1% for a massive 42 days. Only 15 years ever have reached such intense volatility in terms of year-to-date, roughly the third week of April. The graph from Macro Charts, this is the full year walking out. This is where we are year-to-date. Therefore, it might be helpful to know in the previous 15 years that had very, very similar volatility from January 1st until about the third week of April, what happened in the S&P 500 for the rest of the year, and what was the maximum drawdown walking forward from about the third week of April in the calendar year to year end. Median outcome from the third week of April to year end in these calendar years was a drop of roughly 15%. The average outcome for the remainder of the year was a drop of roughly 9%. The maximum drawdown from about the third week of April to year end, significant. The average, roughly 24%. The median, 25%. Now, it's quite possible that you would look at this table and surmise that the rest of the year will be ugly. In terms of thinking in probabilities, we have to keep in mind, in 2020, between the third week of April and the end of the year, we're not going to get a median outcome. We are going to get one outcome. And the median outcome between the third week of April and the end of the year in the positive cases is significantly different, 29.33%. 5 of the 15 cases, good things happened from the third week of April to year end, which is quite a bit different than the median outcome. And in the cases, annual cases, where bad things happened between the third week of April and year end, the median decline between the third week of April and year end was 24%. Again, it might be very, very easy to say when we have a volatile year, as we've had year to date, we pretty much know that bad things are going to happen. That could be extremely dangerous. When we examine each one of these 15 years, the message from a planning or contingency perspective is that history tells us that it's prudent to be prepared for a wide range of outcomes. This is the S&P 500, third week of April, April 21st, 2020, sitting right here. What would happen if we saw the median positive outcome return of 29.33% between the third week of April and the end of the year? And what would it look like if between the third week of April and the end of the year, we had the median return of the poor outcome years? And the answer will tell us that it's extremely dangerous to only plan for green outcomes or red outcomes, because the data says we should be prepared for a wide range of outcomes. In these 5 cases, if we experienced hypothetically the median gain that was experienced in those 5 cases, we would finish the year at 35.39. In these 10 cases where the remainder of the year was red walking forward from the third week of April, and we experienced the median return from the third week of April to year end, we would finish the year at roughly 2070, which is quite a bit different from the message that you might take away from just looking at this table or looking at these figures here or these drawdown figures here. Notice in this case here, third week of April to the end of the year, very positive, no drawdown. This case here, double-digit returns between the third week of April and the end of the year, almost no drawdown. In this case here, a 31% return between the third week of April and the end of the year, and almost no drawdown. Your typical volatile year is going to finish in the red. But when you don't finish in the red, you're basically at the end of a bear market, and really, really good things can happen. And that might seem really, really frustrating. But the facts are, at this point, data in April of 2020 is mixed. That's something that we have no control over. The only thing we control is our own preparation and execution. And if you're totally unprepared for an outcome like this, it's going to be very difficult to execute properly walking forward. And if you're totally unprepared for an outcome like this, it's going to be very, very difficult to execute properly walking forward. That's the valuable message in this data set here. And for some, that message will only become valuable with the benefit of hindsight if they're unprepared for a scenario like this or a scenario like this. One of the main takeaways here is when the market starts volatile year to date in this manner, typically it's volatile for the remainder of the year. You have to keep in mind, volatility doesn't necessarily mean down. This is volatility as well. Range expansion is basically volatility. In all 15 of these historical cases that are similar to April of 2020, a double-digit move in the stock market followed between April and year-end. Look at these numbers here. These are single digits, but you get a double-digit drawdown. This is a graph showing the performance of major sector ETFs since the March 23rd low. Like many data sets that we have in the present day, there's some good news here and some concerning news. It's a mixed bag, but it's not a disaster. Energy in a leadership position, home construction relatively high on the list, materials and retail right next to the S&P 500. This is more of a cluster look here than a leadership look. Wouldn't say that this look sides with full bore risk on, and wouldn't say that it's a total disaster either. History tells us, based on performance year to date, that a double-digit move is most likely coming in the stock market. It could be up, it could be down. And history says it's prudent to prepare for a wide range of outcomes. Therefore, for the remainder of the year, these concepts are appropriate. From Market Wizards, Michael Marcus taught me one other thing that is absolutely critical. You have to be willing to make mistakes. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your best judgment again, and being wrong again, making your best judgment again, and then doubling your money. In any environment, it's not realistic to have an expectation of a 100% success rate on allocation adjustments, but when you have an environment like this, it's even more unrealistic. The objective is to get on the right side of the next big move. And as we've been saying for months, to do that, it's going to be messy along the way. If you've been trading in the markets for a long period of time, or if you've just read a lot of books about successful trading and successful investing, these concepts make sense to you, and it's really nothing new. Inexperienced investors and traders want forecasts. They're looking for certainty in an uncertain future. On the other end of the spectrum, experienced investors and traders who monitor and adjust. These are charts of the Dow and S&P 500. This is the 200-day moving average. Before we begin, there's nothing magical about the 200-day or any data point or indicator. This is a simple example to illustrate concepts about using hard data. The same concepts apply to the weight of the evidence. These are all major lows. You really didn't have to predict anything. This is what a bear market looks like. For the most part, price is below a downward sloping 200-day moving average. This is what the bottoming process looks like. This looks different from this. This, after the major low, looks different relative to the bear market. After the major low, looks quite a bit different relative to the bear market. And once again, after the major low, it looks quite a bit different relative to the bear market. The same exact concepts apply to a 20-day moving average, a 50-day moving average, a 100-day moving average. And the same concepts were helpful after the 1987 crash. It just wasn't particularly helpful to use the 200-day. Something like the 100-day was more important in that environment. All time frames are relevant. There's no magical moving average, magical indicator, or simple way to assess the weight of the evidence. It basically requires hard work. These same concepts apply in the present day. If we focus on the weight of the evidence, eventually it will get us on the right side of the trend when a sustainable bottom forms. In any environment, and especially in an environment like this, your last trade is a sunk cost. It's yesterday's news. In this environment, and in any environment, all we can do is review the data that we have in hand and then make the best decision possible. Just repeat that process over and over again. If our process is sound, eventually, the probabilities and the data will get us on the right side of the trend, which is why we always talk about being flexible and open-minded. Had an example of it this week. Last week's video covered a lot of bullish-looking historical studies. We don't trade the historical studies, we trade the chart in front of us. And when the market started to look a little bit more vulnerable this week, we decided to take some profits off the table. Trades we entered on March 26th, April 6th, and April 7th, after the chart in front of us improved. Maximum flexibility. More about this tweet can be found in this post. Given that only 33% of the cases were positive between the third week of April and year end, this data set really helps us with keeping an open mind about worse than expected outcomes. Is there anything that we can do to look at this data in a little bit more detail? The answer is yes. This is a separate analysis, but then we'll tie it back to that analysis. This is the percentage of NYSE stocks above their 200-day exponential moving average. We have data going back to 1986, which is pretty good for breadth data. This is what we want to focus on now, where these arrows are here in the center of the screen. This is an extremely rare oversold level that we just experienced in 2020. Similar to this point here and similar to this point here. The market's only been that oversold 2 previous times dating back to 1986, which spans roughly 34 years. Oversold in isolation tells us to be ready. When the market starts to move and react to an oversold reading, it tells us the probabilities are improving. So only 2 previous times have we gone from this point to this point, right here and right here. Thus, it might be helpful to know, how did the S&P 500 perform from this point and this point? Given one of them comes after the 1987 low, the other one comes after the March 2009 low, it's not shocking that performance is outstanding in both cases. Very satisfying performance from 2 weeks out to 5 years out. After the 1987 crash, in this case from January 22nd, 1988, the market gained an additional 76%. In the April of 2009 case, additional gain, this does not include the gain off of the March 9th low, 124% 5 years from this date here. Now let's tie this data here, this chart on the left side of the screen, to the macro charts data and analysis that we just covered and see what we can learn. We have breadth data spanning all of these periods here. So in the most volatile year cases, we can include 2000, 2001, 2002, 2008, and 2009. So visually, looking at those cases on this chart, and to do that, we'll ask some simple questions. How many of these years had a similar oversold reading to what we're seeing in the present day? How many of these years rallied from a similar oversold reading? And how many of them had a similar 4-week rate of change for the NYSE stocks above their 200-day exponential moving average? Answers. Only 1 year or period can answer yes to all 3 of these questions. April of 2009. April of 2009, similar oversold reading to the present day. April of 2009, we rallied from the similar oversold reading. Right here, we went from the lower line to the upper line. We just did it in the present day. And the 4-week rate of change for the breadth indicator. Here's the move in the present day to the green line. Here's the move here to the green line. The blue arrows show these periods: April of 2000, April 2001, April 2002, and April of 2008. If we ask the same questions, are we oversold like this anywhere in here? Nope, we never get that low. Therefore, we can never see an oversold move like this in any of these cases, because the market never gets down that far from an oversold reading perspective. How about the rate of change? You see any spike like this in here below these blue arrows? Nothing. This spike here is similar to this spike here. This move here is similar to this move here. If you look in this region here, we don't have any of that. We never come down into this region, and that's how we answer these questions. And remember, the reason why we're asking those questions, we're tying this analysis back to the macro charts data that we opened the video with. And let's take a closer look at the rate of change question. This is the 4-week rate of change in the NYSE stocks above their 200-day exponential moving average. This is somewhat a form of a mini breadth thrust. Right here, there's your thrust. There's your spike in the rate of change. Here's a big spike here, happened right at the low in March of 2009 into April 3rd. April 3rd, 2009 is similar to April 17th, 2020. April 17th, 2020 is also similar to December 31st, 1987. Notice the spike in the rate of change only happened 2 previous times similar to this point here. You don't see it anywhere in here or anywhere in here get a spike that big. We know good things happened walking forward in 1987, and we know good things happened from April 3rd, 2009, walking forward. Simply speaks to probabilities about April 17th, 2020. Only seen a look like this 3 times in the last 34 years, and this is the 3rd case. So this table where we answered the questions, these dates here are these dates here. There's only one date that answered yes to these questions, April 21st, 2009. The return between April 21st, 2009 and year end was 31%. The drawdown was very, very minimal. And when we look at this case individually, it's quite a bit different than any conclusion that we might draw by just glancing at this table and looking at this box here and this box here. When you start the year with a really, really high volatility profile, the odds are bad things are going to happen. But the April 2009 case tells us it's also possible that really good things could still happen. And there's absolutely positively no harm in being prepared for a wide range of outcomes. And there could be significant harm for failing to prepare for a wide range of outcomes. The only thing we control is our own preparation and our own execution. Is there anything else that we can do to try to discern between what the rest of the year might look like in terms of looking at these historical cases, which are all similar to April of 2020? The answer is yes. Remember, I said we were going to double back to the text inside of this article. And specifically, I want to focus on this text right here. Central banks in the group of 7 countries purchased 1.4 trillion of financial assets in March, nearly 5 times as much as the previous monthly record set when? April of 2009. This is the look of your quantitative easing in April of 2009. This is the look in the present day. April of 2009 was the previous monthly record. April of 2009 was the only case out of these cases that could check these 3 boxes. All of this on the screen here helps us respect the positive outcomes in this data set, and the topic that we're about to revisit helps us respect the negative outcomes in this data set. Central banks are an incredibly important factor. And if you've been in the markets for a long time, you know that's probably a gigantic understatement. However, as we noted a few weeks ago, the Fed can only directly address 2 of these 3 market concerns. And in this case, it can be helpful to think in extremes. Think of it this way. Would central banks be able to keep the markets propped up if nobody ever went back to work? And I know what you're saying, that's ridiculous. But it helps illustrate a concept. The longer the virus impacts the economy, the lower this apex will be in the future. Yes, it is ridiculous to say that we'll never go back to work. But would the Fed be able to keep the market propped up if nobody went back to work for 6 years? Of course not. What about 1 year? Of course not. What about 6 months? I'm not sure. Telling us that there's some tipping point related to time where the economic damage will start to outweigh anything that central banks can do. Central bank actions are extremely important. The economic data and the headlines are also relevant. Eventually, all of the stimulus that's been pumped into the system has to start to show up in the real economy in terms of some improvement. At some point in the future, that will happen, which takes us back to this time-related wild card. A few weeks ago, we said change in consumer behavior. What do we mean by that? Consumer behavior before the virus will not necessarily be the same relative to consumer behavior on the other side of this thing when things start to open back up, something that was noted weeks ago. We already have evidence of that. Headline this week, April 22nd, German shoppers not rushing back as stores reopen. It's going to take time for this to flip back into this. There are serious economic concerns, things that are going to have to be dealt with in the future, including a lot of decisions around the globe about debt forgiveness. 1 trillion is a big number. With everything that central banks have done around the globe, when we turn, it will most likely be an extremely aggressive and confident turn in the financial markets. It will be very, very easy to see that we're back to full-bore risk on. That may be happening now, but we're not quite there yet. Earlier in the video, had think in probabilities. We've been talking about these scenarios for weeks. All of it aligns perfectly with this concept from Market Wizards. Don't worry about what the markets are going to do. Worry about what you are going to do in response to the markets. Yes, we want to try to assess probabilities, but we don't need to predict if this table will morph into a positive move between now and year end or a negative move between now and year end, if we're confident that we can handle both scenarios. I really don't have to worry about this or this if I'm confident I have a game plan. And all of that aligns perfectly with this quote. This quote is a game changer. When you start thinking this way, everything starts to shift. And these concepts apply to all time frames, especially near an inflection point. Even though we're long-term investors, near an inflection point where you could get a big move up or a big move down, 60-minute charts can be helpful relative to trying to make decisions. This is Thursday around 12:30 p.m. Eastern Time, 60-minute chart. It looked like here that the S&P 500 was going to clear 2035 and it had a chance to run all the way to 2942. That didn't happen on Thursday. This was a breakout and then it turned into a failed breakout. We redeployed some capital right here on this breakout. And then by 11:04 a.m., still a long way to go to 4 p.m. What does that mean? That means we've probably seen something that says this gain may not hold. This short-term breakout here that looked like it had a chance to run turned into a failed breakout. And this nice gain that the S&P 500 had, this is roughly 36, 38 points around midday, was given back. And I believe on Thursday we finished slightly in the red. Still unsure whether this little scale in here is going to work out, but that's yesterday's news. If it works out, that's fine. If it doesn't, we have to move on to the next decision. And why would you possibly scale in if we're going to move from 28.35 to 29.42? Because a move like that would align perfectly with the breadth studies that we covered in last week's video. Confident moves tend to follow something like this. We're not trading this, we're trading this, and a move from here to here would really be following this type of script. But this is not the chart in front of us. It's simply a reference point. This is the chart in front of us, and the chart in front of us is not literally a chart. It speaks to all of the 2020 data, everything that we can consider in 2020. Present day data. Historical studies simply provide context. Just as this data provides context, telling us to be prepared for a wide range of outcomes. Are all of the bullish studies from last week still relevant? Of course they're still relevant. Still something that happened in the present day. This is not a certainty. This speaks to probabilities in the present day. How could something like this happen walking forward? Really, any good news related to the virus could trigger really big moves in the stock market, and that is to be determined. There's an April 23rd study. You can pause your video player, but it does contain some positive news, potentially, relative to the virus, just as there's plenty of concerning news out there relative to the virus. Assessing odds is significantly different from predicting or forecasting. Our objective is to make money, not to protect our egos or not to impress anyone. If you want to impress yourself, work on this. The best way to do that is to trade the chart in front of us and take it day by day, allowing us to be prepared for a wide range of outcomes. We open the video with this tweet from Macro Charts. Macro Charts, 25 years of experience in the markets. If you look at this tweet, the last two words, stay nimble, seems to align with everything that we've talked about in this week's video. Kathy and I have been in the market since the 1990s. I'm in my 26th year. Like macro charts, I can state unequivocally that these are important concepts. And the only way that we can do all of this is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.